Good afternoon, and welcome to this focus panel on pension funds and their imminent central clearing of OTC derivatives. My name is Ross Lancaster. I'm Head of Research at Acuity, and I'm delighted to be moderating this panel today. As many of you will know, pension funds in Europe have been operating under an exemption from centrally clearing their OTC positions for the last few years. But that is due to change in June, when they'll be formally obligated to do so. Now, this discussion is not just a discussion about regulation. It also brings in issues such as liquidity provision, collateral management, and managing rate risk. So I'm very happy to present a panel that can provide expertise on all of those topics this afternoon. Please could you join me in welcoming to stage Mattila Palla, Secretary General and CEO of Pensions Europe; Max Verhagen, Director Financial Markets at Cardano; Jamie Gavin, Head of OTC Prime Clearing EMEA at Societe Generale; and Frank Odendaal, Head of Securities Financing, Product and Business Development at Eurex. So I'd just like to start by some housekeeping. As you're probably aware by now, we will be running some poll questions throughout this panel, and you can vote on those by scanning the QR code on your tag, where you can also submit questions for the panel, which we'll address as we go through. So, welcome to my panel. Obviously, I gave an overview of the regulatory backdrop to this topic. But Jamie, if I could just come for you for a bit of an overview and in terms of what you're seeing on the ground, both in terms of cleared interest rate swaps, but also cleared repo, because that's going to be a major part of this discussion as we go through the afternoon.
Yep, absolutely. So we've now been clearing IRS for clients for nearly, well, over 13 years now. So as we come towards the expiration of the clearing exemption for pension funds, it really represents the final chapter in moving everybody into clearing. So I think of the latest stats from ISDA, 78% of the interest rate market is now cleared. So this really represents the final last piece going into clearing. We're very well established in terms of how the operations work with clearing and onboarding clients. So whether it's trade flow, margin and collateral, or compression, all of this functions very well now. So if anything, the clients all the other clients have ploughed the way for pension funds to now come into clearing. And we're actually seeing some voluntary rates clearing as well from pension funds. So whether they're benefits in terms of counterparty risk, improved segregation, use of credit lines, or compression and netting, there's definitely reasons why clients have started clearing earlier, as well as getting ready ahead of the exemption. So in terms of onboarding EU clients, we see demand across the CCPs, and some are single, some are dual use, and of course we'll come on and talk about the active account strategy later on and how that's going to influence things as well. But at this moment, it's quite orderly, and we see that the open interest is definitely building in Europe. Some of that is opportunistic and driven by the basis, but we are seeing a continued build-up of euro clearing in Europe, which is very positive.
Fantastic.
In terms of repo, it's a lot more nascent. So we have a number of clients who are live, but they are using it on a committed basis. So it's not sporadic. There are some fairly significant positions on the clearing houses at the moment, and we're seeing balances increasing, more requests for capacity, and there's a lot more interest in terms of client engagement now occurring in Europe as well as in the UK. And the feedback that we're getting from clients who've gone live with cleared repo is it's a very straight through and efficient process, and they're actually surprised about how easy it's been and compared it to the cleared rates market. So all of that is very positive, and we're continuing to seeing it build.
Thanks. Frank, could I bring you in to get the kind of clearinghouse perspective on cleared repo and kind of what you're seeing on this front?
Sure. Perhaps first to say that even though it's been around for a long, long time, not people, especially on the buy side, are not really familiar with it. So repo clearing has been offered at Eurex since 2000, so 22 years in total. Has seen a lot of evolution and improvements, changes over the time. But I think it's important to recognize as well, today, the large majority of repo clearing in Europe is still done by the banks themselves. For the house business, managing treasury liquidity, refinancing securities positions. And this has been growing over years, right? There was an IGMA survey came out just a week ago, estimating the European repo market size at around 10.4 trillion euros. Now, the euro-denominated business is around six-ish, and 50% of that is cleared centrally, right? So I think it's interesting to note, even though Eurex succeeded in onboarding the 3 largest pension fund managers from the Netherlands in our cleared repo program, by and large, we estimate maybe 1-2% of the currently cleared repo market is done by the buy side. 99%, 98% is done by the sell side. So it's a big market to grow, but it's growing actually. The repo market has been growing for 5 to 10% over the last few years. Year on year was 12%, clearly with positive rates, and you will see some charts later on across all the repo CCPs out there in the Eurozone. Has been an enormous increase in activity.
Great, thank you. Max, could I bring you in here? Because obviously in your day-to-day you have multiple conversations with your pension fund clients as an LDI manager. What are you seeing in terms of their preparedness for kind of cleared interest rate swaps?
Yes, speaking for my client base at Cardano, we're servicing around 50 pension funds. The largest out there is 30 billion. So in your perspective, that's maybe a smaller pension fund. And they would classify or categorize as a small financial counterparty. So would be, let's say, exempt from the clearing obligation in June this year. However, we are also advising, and we are clearing voluntarily for most, if not all of our pension funds. And that's driven mainly also on, let's say, the trading. The trading of non-cleared bilateral interest rate swaps on a, CSA that has bonds in it, it's still very difficult. There are banks out there willing to provide liquidity, but then if you come to restructure or unwind, you'll have a lot of discussions. So for comparison, if you want to trade bilateral swap 30-year, it might take you an hour to do the price discovery, while in a cleared space, where everything is standardized, you're done in a minutes or whatever seconds. So from a trading perspective, clearing makes perfect sense. And so we're setting up, let's say, this flexible shell, if you like. We have a legacy portfolio of non-cleared that will remain, I guess, but moving forward, clearing will be the end game. And obviously then the big change for my clients is that we have to exchange VM, variation margin, in cash. And therefore we need repo, but that's something I maybe discuss later.
Yes, we'll come to that later. We're going to have our first poll question now, which should be up on screen. I'll just wait for that. But when it does come, it's do you clear the majority of your IRS at 1 or 2 CCPs? Great, that's up now. So we're just going to let that run for a bit while people vote on it. But Max, could I kind of stay with you and talk about this is finding effective concentration and getting the right split for your clients, for their portfolio among clearing brokers?
Sure, yeah. Obviously, clearing for my client base is something new. They are very busy with pension contracts and to servicing their clients, the pensioners. But in managing the risk in the derivatives markets, now they are, let's say, confronted with clearing. So we explain you need at least 2 clearing members. So my clients will never be a direct clearing member, so they need a client clearing service of at least 2 clearing members. And then you come to the fact, how do you split that? And that's something that many of our clients say, okay, agree, I will take two clearing members. I will sit one aside as a backup and clear everything with the one of my preferred clearing member. However, we discussed it also last week in the Eurex seminar. Porting is something very important in this whole clearing space. So we are forced to clear, well, the bigger ones. But if the porting mechanism doesn't work, we actually have a big risk. To facilitate porting, you need to have, I think, 2 active clearing accounts. You're talking about concentration. I think you want to split your clear portfolio over at least 2 clearing members and always be able to port your trades. So the amount of BPVs you're clearing determines how are you concentrating one, or maybe you need more clearing members if you're bigger.
That's really interesting, thank you. So we've got the results in, and we can say that the majority of people clear the majority of their IRS at 1 CCP. Jamie, what do you think are the drivers behind these decisions and kind of where flow goes for CCPs?
I think it's really practical considerations. So I think it's down to time, capacity, and it really comes down to those teams that are doing the onboarding, especially to Max's point, if they're taking 2 clearing members, some of the larger pension funds, they might have 3, 4, 5 clearing members in order to guarantee that portability. It's that time that it takes in order to put those other clearinghouse services in place. And I think the other issue is just around trader habits as well. So I think what you tend to see are a trading desk will be very comfortable executing and clearing in a single place. Their curve will be attuned to that specific clearinghouse, and if they then have to split that amongst clearinghouses, that adds some complexity that obviously takes time, it takes budget. So it's more a practical consideration, I think, than anything else.
Great, thank you.
If I may, this question relates to the CCPs, obviously. I was relating to the clearing members, but interestingly, 25% of the audience is clearing at 2 CCPs. They are, I think, practically playing the basis, right? Which was also a discussion of the last panel. And yeah, that makes sense with the basis that is so different in different maturities. But if you can make money as a fiduciary, you need to trade at those places where you get the best value for money. And I relate to this 25%, I guess, to maybe choose between CCPs.
That's good, thank you. So we're going to move to our next poll question, which should be coming up in a second. As before, please vote using the app. We're trying to determine here, for pension funds, what percentage of your portfolio are you clearing ahead of the exemption requirement? And so I'll kind of slightly put that question to you, Matti, while we're waiting for results. How are your members using clearing so far or preparing to clear?
Yeah, we're in the process of trying to find out that. So we don't have statistics on that. We know more about the big Dutch pension funds. So from some markets, like from the Netherlands, we know, but we're surveying our members, and hopefully we'll find out more. I think in smaller pension fund countries, there's maybe not that much awareness, maybe not that much need to clear. But if they need to clear, start clearing, and if they haven't started, of course, time is running short. So we're trying to raise awareness of this. All in all, on this central clearing, I think we think it is important managing the counterparty risks, but also I think in the bigger picture, financial stability, central clearing is an important part of that, and of course for pension funds as long-term investors in financial markets, that's key issue, and pension funds need to manage risks, interest rate risk, currency risks, and of course using bonds, but that's not enough. So you need to use derivatives, and you need to use those in risk management and effective portfolio management, and there's increasing emphasis on this risk management part of pension funds. So increasing reporting requirements of derivatives, but they're also increasing requirements in managing this as part of your risk management. So I think this is moving forward for us, and we're taking measures. And of course, the bigger pension funds in the Netherlands, in Denmark, in the Nordics, I think they've done a lot, and they have everything or many things in place already. But there are many parts of Europe that we still don't know.
I mean, Max, I'd be interested to get your perspective here as, a lot of your clients are smaller pension funds, and what kind of impact is this having on them?
The impact of clearing for my pension funds, you mean?
And preparing for clearing as well.
Preparing, yes, absolutely. What I mentioned, we are advising them since, well, a couple of years to indeed voluntarily clear. Again, based on the fact that we can get the best result from a trading perspective for them. Risk management is something, obviously, that now is definitely on the table. So I have to explain what are the risks in clearing, right? So before, in a bilateral space, you have 10 counterparties. If one goes bust, you have to, replace those transactions to one of your choice. In a cleared situation, smaller pension funds typically have 2 or maximum 3 clearing members, and you're concentrated. So the risk is much more concentrated, but we have to be conscious of the fact that clearing members are also banks. And Credit Suisse was, I think, they subtracted from the clearing space, so then they didn't offer any clearing services. But that would be interesting to see how that would work out if UBS were to take over all those clearing clients. But so the risks, we have to explain that, how that works. And then again, there is some discomfort about, let's say, is porting possible? Because at the end of the day, that's where it is. But we are voluntary clearing, absolutely, because we think we can do the best for our clients on the trading perspective.
Great, thank you. So the results of the poll are in, and we can see that in terms of the percentage of people's portfolios that are clearing ahead of the sanction inquiry, most people are clearing about 50% already. Great, off on screen. So, Frank, could I come to you and touch on these issues, kind of cost of clearing, and maybe, for people who haven't yet, are still preparing, just give a more detail on what they can expect on that front, and how they can alleviate it through tools like cross-margining.
I'm thinking on the cost of clearing. I think the cost issue has kind of changed dramatically over the last 4 or 5 years as the UMR, uncleared margin rules, came into force. Before, there was a lot of bilateral conversations and agreements which allowed a lot of freedom. Many times there was no exchange of margin or only very high threshold levels. Has been now taken away, that option kind of. There's been standardization, more or less. And there have been lots of, if you have to post margin now or collateral for something bilaterally or CCP, there's not much change anymore. You still have a lot of hassle though, if you continue with bilateral, while in CCP, as Max mentioned earlier as well, I mean, you have this, for CCP, right, this ability to standardize processes. You don't have to do 10, 20 different relationships, etc., just when it comes to collateral management, etc., from you. So cost of clearing, whilst there is always the contentious item about margin levels of a CCP, well documented. I think in general, because we have now SIM and we have UMR, in general, there is not as much difference anymore. And that comes on the IM level, but also on the variation margin level, because whilst the regulation in the uncleared space, it gives certain leeway, reality is different, because the banks have been pushing very hard not to accept securities as variation margin, even in bilateral space. Some with success, some with not, but in general, there's a lot of pushback. So for that reason, again, when we come later on about liquidity management, what's the perceived cost when it comes from the pension funds perspective, at least, again, there's been lots of research around this topic, that's, it's also there now in unclear margin world, right? Yeah. Just maybe not exactly at the same time, the same moment, but it's still there.
Jamie, could your perspective on this, because obviously you guys have been very active on cross-margining at SocGen.
Yeah, I think so. If we think about the cost of clearing, back in 2009, 2010, I think there was a real concern that clearing, the fees, the provision of variation margin in cash, the extra initial margin compared to bilateral margining at the time was going to cause a decline in the derivatives trading world. That has obviously changed over time, and we've seen levels exceed where we were at the Lehman crisis. I think in terms of specifically the use case of cross-margin, probably not specifically tied into pension funds, but more broadly across clients, there's definitely an opportunity there that if you're trading futures at Eurex, and then you also want to be able to, you only have a euro rates clearing book, or you have part of a euro rates clearing book that you can move over, then it definitely makes sense in order to gain the benefit of those savings. We do have clients who are live, and generally, So sometimes you think, don't believe the hype in terms of the saving that's available, but they are seeing 40% savings on initial margin, but by using that process. So if it's something that makes sense in terms of the rates book and the futures book, we think it's definitely beneficial for clients to look at that. And we also think that, as we get further on down the line, as other products get moved into the margin model, that there's greater scope for efficiencies there. And we, again, that's something that we think will help.
Thank you. So obviously, the cash requirement for clearing is going to be a big issue for a lot of these pension funds. Matti, can we talk a bit about the impact that you're seeing from having to have cash ready?
Yeah, I mean, we had what was it, 10 years of exemption, extension of the exemption to find other solutions than posting cash as a variation margin, but no solution has been found. So that is an issue. Pension funds, of course, usually don't have a big allocation to cash. You have high quality government bonds and originally pension funds. That was the position that we would like to use those as then for the margin requirements. Pension funds really cannot hold cash buffers big enough. And of course, if you were to hold them, you have them in the bank accounts, you have different risks. So it can be even more risky than having them in government bonds. So there are various issues. And of course, for the fact that if you start holding a lot of money in cash, then you give up investment returns, and that's has an impact on the returns, which are important for the outcome of the pension savings. So that is a fundamental issue that remains open. But as it looks like now that cash is what is required. And then we've discussed this especially, even before, but especially after what happened in the UK in September with the European authorities, ECB and European Commission and EIOPA, the supervisor here in Frankfurt, whether this could be a problem for pension funds, liquidity issues, and posting then cash. And it really comes down to the liquidity of the repo market, and basically the understanding is that in normal situations, normal circumstances, within reason, it functions. But if it's more stressed situation, then it can be a problem for pension funds as well if they need to transform their high-quality government bonds into cash intraday or within a very short period of time. And then especially the bigger pension funds have been questioning whether the repo markets would then remain liquid and what could be done about that. And the suggestion that we have had is that then ultimately the central bank could provide liquidity to the markets in this situation. We'd rather do it before the crisis and not during Saturday and Sunday on any given weekend. So it would be better to deal with this in advance, because it looks like central banks and regulators and governments take a strong role in dealing with these types of risks and crises in the market. So that is an issue for us, the posting cash as variation margin, and especially for the really stressed situations.
Right, thank you. We should be seeing a slide shortly showing the amount of outstanding and trading volumes at Eurex repo, which we can see do kind of spike in these stress situations. And Frank, I'm going to come back to you on the cleared repo as a solution, because it obviously it doesn't behave the same way in stress scenarios as the bilateral markets, does it?
I think, yeah. The good news is we have quite a lot of data, right? That's always an issue in general. Many ideas and solutions which are offered for some certain problems, maybe. As I said earlier, we are around there. That's Eurex in front of you, right? Since 2000. How the different market segments we operate evolved during a lot of crises, as we all know. And we picked out a few, but I think the most important one to really focus, we have two market segments, and I don't want to bore you with the different aspects. But this green line is basically what's used as a funding for cash management for treasuries. As I mentioned earlier, 99% today is managed by bank treasuries, right? Now we talk about the pension fund treasury, so to speak, or the asset manager. That's exactly the concern. I need to raise money, and depending which survey and analysis you do, 1% move on the euro swap curve in the 20 or 30-year point by 1% up, somewhere between 100 billion and 50 billion, kind of. That's somewhere in the range. Regardless where we agree on which number, it's a big number, right? And that's huge. Now, personally, coming from a derivatives background, I would have thought this is impossible. But then we look at the LDI stuff last year in October, September, and it happened there. So it can happen. Now, what we see here are some number of crises, but you can see, the debt crisis. I think that's always the token example there. We all may remember when Italian government bonds were yielding 7%. That was a very controversial time, and Greece, etc. This was when our volume in the CCP cleared market really peaked in the funding, right? And we've seen the COVID volatility each and every time the market and the CCP was open for business. And there have been numerous studies by the IGMA, ERCC on this topic. And again, last time around on COVID, they came back to the conclusion, yes, the CCP market was open and was running, right? And that's our case. Yes, having the whole pension fund industry in the CCP will, of course, will be a challenge maybe, but maybe come to the next slide. There we see basically what this was outstanding business. This is daily trading, and you can see what numbers we're trading, and that's only Eurex, which maybe has 20-25% of the market in the CCP world, right? So there is a lot of growth, and there's a lot of liquidity already. And there are already central banks connected, not maybe as a backstop solution, as earlier alluded to, but from a portfolio management point of view. So I think the point we want to make from a CCP point of view, we have a lot of data to show that there has been a lot of liquidity. And I think the other topic as well, there have been numerous papers and discussions, to validate that whole story. I think it's also important to see that we have some pension funds live doing this. And they've been through a couple of crises, to be fair, in the last 6 months alone. And I didn't get the feedback there was no liquidity on our platform, right? And maybe Jamie can also comment on his view. But I mean, we didn't see this comeback didn't come to us. So yeah, we don't have yet 100 pension funds live. We have 3 very large asset managers and their clients live, and they're very big. We have to see, but I'm quite confident that given the diversity of stakeholders we have and the historic performance, this should work. Yeah.
And can we talk maybe about reverse repo, because that's another tool that's maybe available for pension funds for investing that cash buffer?
Well, I think one thing to say is when you normally have discussion, and especially given it's been for 10 years, pension fund exemption, this is always I need to raise money. But the reality is, the problem is actually also the other way around. Right? If a pension fund suddenly has a lot of inflows, what can they do with the money? Because the reality is they might have to pay it back tomorrow. So that's really a typical treasury risk, collateral management, cash management problem, right? What do you do? What alternatives do I have? Money market funds, unsecured deposits overnight, if I'm a bit brave maybe, buy CP, right? And that's option. And reverse repo gives you protection, right? And for many years, some large asset managers have been doing this anyway. And what we observe is the use case is really developing also from a reverse repo point of view, right? Because if you give your money to an external, let's say, money market fund manager, this may be great, and they may have a lot of track record and performance as well, but of course, you're out of control. If you anyway do that yourself, keep the bond, you manage the counterparty risk, etc. yourself, you have definitely clarity, right? So we see a lot of inflow coming from that angle as well. And as I said, or you can check it out on the internet as well, I mean, the investment rates are typically above ESTR, which beats most safe and secure collateralized options you may have.
Great, thank you. Just as a reminder, if you do have questions for the panelists, you can send them in by scanning the QR code, and we'll get them up on screen here. Frank, you mentioned the UK LDI crisis, and obviously there are political peculiarities to the UK that caused that, but there are still maybe lessons to be learned on the continent. Jamie, could I come to you first for your opinion, given I suppose physically you were closest to it?
Because I'm from the UK. Thank you. How did I get myself into this mess? I think the UK LDI crisis, occurrence, whatever you want to call it, it really is a lesson in liquidity management and preparation. I think if we compare it to the EU experience, EU pension funds, and Max, feel free to contradict me, they tend to be more conservative in their investment policy. There are LDI strategies within Europe, but they tend to be less leveraged and again, more conservative. And I think what we're also dealing with in Europe is a much larger European bond market as well compared to the UK. So I think we had the perfect storm within the UK in terms of leverage and a smaller market that caused a squeeze and therefore caused the bank to intervene. I think therefore, where we look at Europe, it still raises concerns though for collateral liquidity and is it sufficient? I think what we're going to start seeing is we're going to see a review of reactions to stress, and I think there's going to be a potential review of more conservative stress tests on funds in general. And we think, therefore, that there needs to be, especially for clients, another tool that they can use in order to generate cash at a time when they're in stress. So the OECD recently put out a paper that showed that if you have to permanently hold cash buffers within a pension fund, if it's something like 5%, they're saying that's at least a 30 basis point drag on the fund. So therefore, being able to have another tool to generate that cash rather than having to consistently hold a large cash buffer is obviously going to be an advantage. So cleared repo is by no means a silver bullet, but it's definitely a tool that we think firms that are going to need those large amounts of cash quickly without having a fire sale of their assets is something that they should consider.
Thank you. Frank, could I bring you in? I mean, could you see what happened in the UK LDI crisis happening here on the continent?
I mean, a lot of us said by Jamie already. I think clearly the topic of leverage is an issue. And it's also a bit of benchmarking on the pension fund side, right? Depending where how you hedge, what your regulatory benchmark is. Maybe it's very advantageous to do a lot of repo in securities because, from in terms of maybe asset swap spreads are negative or positive in certain other jurisdictions. So I think that's something which should not be ignored when you maybe see opportunity to do what happened in the UK. I think in general, I think the market is a lot more diverse in the Eurozone itself, not just in collateral, but also more diverse participants, right? Because ultimately there are 5 or 6 very large UK banks or domicile banks who are running the gilt market. It's a lot more diverse in the Eurozone. So I think that's an asset when it comes to a crisis, obviously. And I think you never say never these days, right? I think it's unlikely that we would see a similar development of that magnitude in the Eurozone. At least that's my view.
Thank you. I mean, Max, did this cause concern among your client base and the pension funds that you talk to?
We definitely learned our lessons. We also have a UK desk, so we were very close to the issue. To add to the discussion, I think in the UK is a different situation. First of all, pension funds in the UK are all in real terms. If I look at my country, the Netherlands, we more look at in nominal terms. In real terms, your funding levels were lower, so they were aiming at, you need to get some yield somewhere. And that was, let's say, also a trigger to have more leverage. But then again, you had to monitor whether your collateral was enough, obviously, to cater for that leverage. We have learned our lessons. In the Netherlands, one of the reactions I've seen is that the Dutch Central Bank is now calling in their quarterly reports for pension funds, you have to show me how well you are prepared to take a 100 basis point hit in your interest rates. Now, 100 basis points is maybe, for the euro area, is maybe big, but you could question that if that's big enough. So that is something that you really have to focus on, and you have to cater for that risk. And therefore, I think the discussion on the repos is very, very good, because if you fund that buffer by taking out, let's say, that number of cash you need to set aside out of your return portfolio, you're missing out on the risk premium. And if you then do the calculations, the average hedge ratio in the Netherlands is around 50 to 70%. Well, a lot of that is with bonds, but the rest of it is with swaps. Calculate the swap portfolio, DV1 times 100. That is a big buffer you have to have. And then if you take it out of your return portfolio and do the math for 30, 40 years, and you're missing out on 2% or maybe more risk premium, that will end up in a very discount on your pension. So make sure you fund that buffer the cheapest way possible. And therefore, for me, repo is something that you definitely must use. And then in the end of the day, you're actually using your collateral again, not directly as a collateral for your counterparty, but as a means to transfer your collateral into cash and a cheap way to fund your buffer. So repo is something that we have to do. And we are conscious of the fact that leverage can be risky.
All right, thank you. Jamie, it's quite a speculative question, but do you think that this incident could have an impact on regulatory divergence between the UK and EU with a continued exemption in the UK?
Another easy question to answer. I don't think so at this time. I think what we've seen in terms of the UK regulators' response to leaving the EU is some tweaking around transaction reporting. But generally, the adoption of the existing legislation hasn't really changed. I think, there have been some questions raised in terms of the UK pension fund community and when they will have to clear. Unfortunately, at this stage, that there aren't any answers. So there's obviously an expectation that maybe there will be another year given, but at this point, there's no answers at the moment. But we'll get there in the end, I'm sure.
Well, I suppose on more certain regulatory ground, one big topic of conversation is the active account strategy. What does this mean for UK, EU, CCP equivalents, Jeremy?
Again, I'm going to be practical and say I think it's a plumbing issue from a clearing member level, and I think from a client level it's a little bit more nuanced. But I think for now there is time. We were in the previous panel. Scott was talking about the need for calibration and being careful as to what the active account threshold should be and how they will work. There's obviously some sort of cost-benefit exercise that needs to go on. So the ESRB this week, in their response, they advocated a cost-benefit and risk-benefit exercise to be made in terms of how to tweak that active account. So until we know what it is, we think that's going to take some time to come into play. So that gives us an opportunity for preparation. So again, it's about budgeting, it's about thinking ahead. There is going to be some sort of active account strategy for European clients. They will need accounts to be opened. The extent to which they're going to have to use them and utilize them on a regular basis is still to be determined. But we need to think about that planning, and it's about the sequencing and the use of capacity, both at the client level and the clearing member level as well. So for me, it's more practical consideration than anything else.
Sure. Matti, could I bring you in here? What does an active account actually mean for your members? And again, what's its significance going to be for the smaller pension funds?
Yeah, that's an open question for us. So we're still thinking about our position on the active account. Seems to be a lot of debate going on about this, and some of our members clearly are in favor of this, and some may have some reservations. So we have to decide for ourselves. I think the main issue for us is that we would like pension funds to benefit from the markets and have the best possible products and rates available for them. So that would be a critical view on having any quantitative requirements on how much would be then required in this. But on the other hand, of course, having then these accounts in place so that if for market reasons you need to shift, then you can do that. And then looking at not just having something in place on paper, but actually then testing that it actually functions when you need it. But not having, quantitative requirements, because that would have then, bad consequences as far as what can you get out of the market, and suboptimal solutions maybe, and then also the operational side, execution requirements, all of that. So I think we would be critical on that. But I've seen within our membership that there are different views still on this issue. I mean, looking at the latest developments, like on the equivalence with UK, seems to getting political, even though the European Commission saying it's not political, it's not protectionism. But I don't know how political this active account issue comes. I think that's that's an open question. But I think for us, the main issue is to have good services available and to develop them, and of course develop them in Europe as well. So from that perspective, we would be supportive of the active accounts.
Great, thanks. Max, does that mirror what you're seeing with conversations with your clients?
Absolutely, I relate to Matti and Jamie. As a fiduciary manager, you have to trade the best way for your clients. And up to, let's say, December last year, that meant that we had to bear in mind the cliffhanger that in 2025 we had to novate everything from LCH to Eurex, because that was a political risk. And as a risk manager, you have to cope with that. So we had this preference to trade cleared at Eurex. To be honest, now that we are more given the opportunity to make use of difference in CCPs out there, so the basis again. But then in this interbellum, it's not clear exactly what this active account is. How big should it be? How do you measure it? So we have prepared a new policy, said, okay, at least a percentage of your BPV that you're trading should be at Eurex. If you're satisfied with that, if you have that, then you have more freedom to choose. But it's just a policy that we have done on the basis of information out there. The sooner the better we have clarity is better for everyone, but I absolutely relate to Matti that in the interest of the market should decide where you have the best products and not so much being forced somewhere. That's my perspective.
Great, thank you. Well, we've still got a couple of minutes left, and we've got one question in so far, which is, what will happen in the CCPs due to the Credit Suisse situation? Frank, do you want to
So I didn't get that one.
It's, what will happen in the CCP due to the Credit Suisse situation?
Well, not much really, right? So CCP were more benign than you can imagine, right? I mean, we've seen lots of volatility in the capital markets, but across the CCP universe, not much changed as far as we observed it, right? Maybe something to do with the fact that Credit Suisse left client clearing a year ago. Maybe it would have looked very differently if Credit Suisse would have continued being a major client clearer, right? For good or for worse. I mean, this wasn't the case. So, then there was less fallout, right? Yeah, so that's where we are. So CCPs didn't see any change. We have seen a lot of course, volatility on the trading side, but this was not unusual in a sense. I mean, clearly we had significant volatility, but that's why the markets, what they're for, right? Yeah? But I mean, I don't think a default would have mattered so much in CCP land. I think the question would have been what happens in the next down the line, so to speak, right? Because clearly if a major systemically important bank would have been allowed to default, potentially, we don't know whether they ever had to default, what would happen in the other GSIPs, right?
Great.
And obviously the choice was taken by the regulators in Switzerland. We didn't want to take the risk.
Yeah. Okay, great. Well, that's it. Just left me to thank all of my panelists. Very much enjoyed that conversation. And I'll give you back a minute of your coffee break. Thank you.